Bitcoin is the first and best known cryptocurrency. But if you're new to Bitcoin, there are some basics you should know before investing. I'm Jim Ferrioli, cryptocurrency strategist at Charles Schwab, and I'm going to introduce you to Bitcoin and some of its potential benefits and risks so you can make an informed decision about whether it belongs in your portfolio. Bitcoin is a form of digital currency that can be used for electronic payments or as a potential store of value. Like other financial assets, it can be traded, and its price rises and falls with changes to supply and demand. Bitcoin was created in 2009 as a means of transacting that's independent of a bank or credit card company. It functions using blockchain technology, which is a record of digital transactions that acts as a public ledger. The ledger is maintained by a global computer network that verifies transactions by solving complicated cryptographic math problems. This process of maintaining the blockchain is often called mining because those who pledge their computing power to the network receive cryptocurrency as a reward. In addition to mining, people can also acquire Bitcoin when they accept it as payment or buy it from a digital exchange. Bitcoin is actively traded too, with tens of billions of dollars in transactions any given day. Historically, Bitcoin has had the largest market cap of any cryptocurrency. It's grown to a valuation of more than $2 trillion as of fall 2025 from being essentially worthless when it launched. Its value has soared since 2018 and spiked in 2024 when US regulators cleared the way for trading of spot exchange-traded products linked to Bitcoin. That broadened the pool of investors who could trade it. But Bitcoin's rise has also included several steep downturns. The potential for big swings in the price of Bitcoin is one of the primary risks, and why some investors merely see it as a speculation opportunity. There are also transaction fees to keep in mind, which change based on trading volume and can be high. Fraud is another concern. Crypto exchanges can be hacked, password and private keys can be lost or stolen, and transactions are irreversible. Additionally, cryptocurrencies are not stored in traditional banks and lack the federal protections of other investments. A longer-term concern is that one day quantum computing could get through the encryption protecting Bitcoin's blockchain. That could make billions of dollars of Bitcoin vulnerable to theft. Some factors that impact supply and demand have historically caused Bitcoin's price to move. Competition from other coins is one, especially given Bitcoin's comparatively slow transaction speed. Government regulations are another. For example, restrictions that limit the use of Bitcoin could cause the price to dip, though regulations that provide government backing or allow Bitcoin to be used as legal tender could also boost confidence. The amount of Bitcoin that's rewarded for mining also has an impact. The reward was reduced to 3.125 Bitcoins in 2024, and it's cut in half every 4 years. Historically, the limited supply has boosted the market for Bitcoin and other coins like Ether. So how can investors or traders potentially profit from Bitcoin while being fully aware of its risks? Like other assets, the most basic way investors attempt to profit from Bitcoin is through price appreciation. Buy low and sell high. That can be done by buying Bitcoin itself or using products like Bitcoin exchange-traded products or stocks of companies that hold Bitcoin. Bitcoin may also provide diversification in a portfolio. Over the past 10 years, the price of Bitcoin appears to have essentially no correlation with major equity indexes or bond indexes. Having investments that don't rise and fall at the same time can help manage losses. Bitcoin may also work as a potential hedge against inflation, which has many indicators like consumer prices and how much cash is in the economy. Bitcoin has historically had a low correlation with inflation measures like CPI, but it also has a finite supply, unlike traditional currencies like the dollar. Those factors may mean it can maintain its value better over time than conventional currencies whose supply is managed by central banks and governments. If you're a trader that sees Bitcoin as more of a speculation opportunity than a long-term investment, there are lots of ways to participate. For example, there are swing and trend trading strategies that can be applied to trade stocks, options, exchange-traded products, and futures contracts. So if you're interested in adding Bitcoin to your portfolio, your next question might be, how much should I allocate? Like other assets, it depends on factors like your time horizon and risk tolerance. But given the riskiness of Bitcoin, investors should be prepared for volatility and only risk an amount that you can comfortably lose. The world of Bitcoin and cryptocurrencies can be fast-moving, risky, and exciting. So for the latest market commentary and education, subscribe to the Charles Schwab YouTube channel and check out schwab.com/learn.